Dear investor, the month of May has seen a good recovery in the broad market, a drop in global rates, relative strength in INR, and a drop in crude prices on prospect of a US-Iran settlement are all positive for sentiment towards India. Yield-seeking global investors came in first, enticed with strengthening INR, and the month of April saw the index doing relatively better. In May, hedge fund and HNI activity strengthened as INR stabilized and negative sentiment associated with India-Pakistan subsided. The breadth of the market has expanded. Most indicators, ex of US bond yields, which have moved up, again have been supportive based on recent trends. Higher US yields are digested because it is accompanied with stable to strengthening INR, and the overall equation still works for FPIs, while we have seen some amount of selling from them. We think it is time for alpha. Jan and Feb saw a large correction in the high earnings growth spaces. We had communicated that the drop in these spaces is more on account of technical factors such as INR depreciation rather than anything else. With the technical factors now behind us, we believe that since the high growth spaces continue to deliver strong growth and retain the potential of continued growth in future, the outcomes in this space should be better, and we believe it is time for alpha. Our belief is simple. Markets tend to follow earnings growth. Our portfolios are constructed of some of the highest growth spaces in the country and have a high EPS growth quotient. Corrected for valuations, we believe this construct has the potential to provide sustained alpha over a period of time to our investors. In some manner, we liken the period to the 90s when IT sector emerged new. It delivered strong growth for several years and helped managers generate strong alpha. In the same manner, over the past few years, we have seen electronic manufacturing, new tech, both consumer and fintech, renewables, China plus one beneficiaries, defense, electric vehicles, capital marketplace, luxury plays, as well as hospitals, etc., all get a much better representation in the market. Now, these spaces are relatively younger and offer the combo of relatively higher quantum of growth and longer sustenance of growth. Our portfolios are positioned to capture opportunities arising from such evolving themes in line with our growth-focused investment philosophy. Coming down to Q4 result season, the result season that is currently underway has again shown that newer spaces have seen strong growth in earnings, while traditional spaces more present in the index are delivering growth close to the nominal growth of the economy. Most large companies are no longer the growth leaders. Overall, result season has been better than expected. That's heartening after a long while. Versus a small 2 to a 4% earning growth expectation for various cohorts, the earning growth that we have seen is much stronger and closer to double digit. Commodities have led the earnings growth, but even ex-commodities, the earnings growth have been quite strong. Good thing is that the better than expected numbers have come in almost across the board. Now, growth in EBITDA, which is earnings before interest, tax, depreciation and amortization, is more than the growth in sales, indicating a good support from margin increase in this quarter. We believe that sustained growth in earnings, which is our focus, across market cap spectrum, provides better outcome for investors rather than a focus on market cap segments only. Being, let's say, a large cap focused investor or a mid cap or a small cap focused investor, and our portfolios are constructed accordingly. What are the risks on the horizon? Do we think it's presenting an opportunity as risks subside over a period of time and markets bounce back? Well, the risks that are currently foreseen are: one, the decision on Trump tariffs after the 90-day period is over. Two, also more geopolitical issues may crop up. Israel-Iran situation, for example, can potentially flare up further. Third, downgrade of the US credit rating by Moody's. That's increasing bond yields there and maybe impacting FPI flows. Fourth, new risk in the form of COVID has emerged. Now, taking the easiest one first, on COVID, as yet the symptoms for most people seem to be flu-like. If the severity remains under check, then it may not become a major concern. However, travel and tourism-based industries may experience a bit of a slowdown. We have seen some price reductions there versus the trend in the last quarter. Our thought is markets follow earnings growth and the prospects of it continuing. Geopolitical events hence are not bad for earnings. In most cases, they result in better business prospects. If we see markets of Israel, they have been doing rather well. even markets of Russia has recovered sharply from the lows hit when sanctions were imposed. When money has to flow out in a short period of time, obviously markets will take a hit, but then they have recovered quite strongly from the lows. The risk of US duty outcomes is more on account of volatility in currencies and interest yields rather than business. We export to US less than US dollar 100 billions in total. A slowdown in export of any order does not impact our $4 trillion economy much. Given our keenness to do business with the US, chances are that we get a more favorable term, resulting in some better market access for our companies into the US. Mostly hence, the outcome would either not matter much if it is negative or maybe only a marginal positive. It doesn't impact overall Indian economy much, but yes, it may have outcomes positive or negative for corporates. Moreover, if we see the contours of the Indian-UK FTA, our gains are seen in spaces which are of marginal presence in the market, such as textiles and leather. Hence, a direct impact is very limited. The volatility we saw in Jan-Feb was on account of yields moving up and currency depreciating. This threat again, the threat of US yields moving up or sharply or a significant currency volatility on inflation and economic slowdown worries, we think is low because this time around, this event is not in the unknown realm. Market participants appear to be factoring in the likelihood of US retaining the 10% import duty for countries who have a deal and maybe charging 26% to countries who don't have a deal, is how I would put it. If the final outcome is similar, currency and bond market should remain relatively stable. Now, Moody's downgrade of US is pushing bond yields higher, but is keeping US dollar relatively weaker. USD has depreciated against euro and pound. While yield-sensitive FPIs may reduce exposure, we have seen some selling, leading to some pressure on the part of the market where there is F&O. However, the activity of levered India ultra HNIs who may borrow in forex and hedge funds is as yet not impacted because they are more sensitive to currency and that is holding steady. In fact, most of the larger international houses expect Indian currency to hold steady and maybe appreciate. This is a good combo to aid our alpha generation as we are positioned away from the index. If currency markets remain stable, oil continues to be sub 70 and with DXY remaining below 100 indicating some movement away from the US dollar, these factors we believe could support the outlook for Indian equities going forward. Now, any correction in the market on account of currency and bond market movements as we saw in Jan-Feb may present a potential investment opportunity while we believe it will be more steady this time around. This year has already witnessed 2 cuts in Indian regulated rates. And now there is an expectation of 2 to 3 more cuts compared to earlier. And this is versus the forecast of just 2 cuts for the entire year at the beginning of the year. Lower oil, lower inflation, lower interest rate and better relative growth in our investee spaces contribute to a constructive environment for our growth or focused investment approach. Hence, while there are many worries, they may not have negative outcomes for the markets unless a nasty surprise comes about. In most cases, we think there may be a positive response as the risks sorts itself out and the outcomes are less negative than feared just now. While domestic investors have continued to invest, FPI flows have been less consistent. In the month of January and February, we witnessed strong FPI selling as bond yields and currency became volatile. This changed over March and FPI have been strong buyers on several days as we saw stability in the forex markets. If we look over the past 2 years, while FPIs have been very keenly followed, overall they have not bought or sold much. Cumulative FPI investments over the last 2 years is a negative $3.7 billion. In the same period, domestics have poured in US dollar $103 billion. We have been maintaining that domestic money flow in the market appears to be part of a structural trend as India gradually shifts from a country of savers to a country of investors. Coming down to valuations, While markets have recouped some losses from the bottom, and particularly after March 15, in the process digesting the impact of Trump tariffs on April 2 and India-Pakistan war on May 10, around May 10, various indices are still 5 to 15% lower than the peak reached mostly around September 24. High growth part of the market has recovered, and many stocks in some spaces like defense are at new highs. However, many high growth names are available over 20% lower than their last 1 year highs, with lower Indian yields, lower inflation, and with expectation of more rate cuts and with sustained earning growth differential versus the index. We believe these spaces would attract investor attention over the next period. We believe that the next period hence should see growth style of investing, which we follow, having an edge over the value style. With that, thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.